All right, ready to take notes for savings tools. This is a 3-page note-taking guide that you'll find on Classroom, and you'll need to open that in DocHub and fill in the notes along with me. So the first thing is to define savings tools. So the official definition is here on the screen, and you should see a similar graphic organizer on your note-taking guide. Savings tools are secure and liquid accounts offered by depository institutions assisting in the management of a savings fund. So this is a long definition that just means that they are accounts at your bank that are there to be secure, a secure way to store your money, but also be able to access it. And some examples are a checking account. If a checking account is a savings tool because you are storing your money there, a savings account, a money market deposit account, and a certificate of deposit. And we will go into each of those in the next few slides. So 2 reasons why savings tools are ideal for storing emergency savings. So the first reason is that it is secure. The accounts do need to stay within coverage limits, but the limit is like $250,000. So I think we're good, but it's a secure and insured way to store your money, better than, say, putting it in a jar in your home where it could be stolen, burnt, many things that could happen to things if we just leave them at our homes. And then the other reason is that it is liquid. So a savings tool is not a place where you're putting your money where you can never access it again. Liquid just means that you are able to get to that cash fairly easily if you need to. All right. So each savings tool does have different characteristics, different interest rates, different amounts of liquidity, the ease of access, and different features. But the goal and the important or why it's important to understand the features of the savings tools is to determine the savings tool that is most appropriate for reaching a financial goal, specifically your financial goal. Now, the second page of the note-taking guide looks like this. And just notice that we're going to cover each of these separately: checking account, savings account, money market deposit account, and certificate of deposit. I believe I have about 2 slides for each where you will be able to see the definition of each, the interest, whether or not it earns interest and how high the interest rate is, the liquidity, meaning the accessibility, how quickly you can convert it to cash, and any additional features. I'm not sure why there's a separate column called additional information, but you probably won't see anything labeled additional information on the slides. Just use that if you need extra space for the features column. And back to this. Okay, starting with checking accounts. So the definition of a checking account is an account that provides an easy method for withdrawing and depositing money. Most of you have a checking account or have at least experienced checking accounts before, so that's not new. The interest on this one, some checking accounts do offer interest, but most don't. And if it does offer interest, it's going to be really low. It's going to be probably your lowest option. So we're not putting money into a checking account typically to earn interest, but it is a possibility. And this is going to be your most liquid type of savings tool, meaning you can get that cash as fast as you want. You can go to the ATM, you can use your debit card, you can go in and withdraw, and there's no limits typically, there's no fees for doing so typically, and therefore it qualifies as the most liquid. Some features of checking accounts, and feel free to summarize or only write what you can fill in this blank. It reduces the need to carry a large amount of cash, and therefore you have a lot of money, but you don't have to carry it around with you. You can put it into a checking account, and then it's technically saving it for you, right? Different types of accounts are available. Some have fees, some don't. Some have specific requirements, some don't. We talked about a little bit of that in the depository institution mini unit. If you are using a credit union, these are known as a shared draft account. Same thing, just different name. And it is not recommended that a checking account is your only way to save money. Savings accounts are accounts designed to hold the money that you're not spending on your current consumption. Consumption meaning consuming. So, what you're using regularly, that's what belongs in your checking account. And then other money that you want to set aside and not spend belongs in your savings account. Typically, that was a weird word. Typically, savings accounts do earn interest. It's still very low compared to other savings tools that we'll go over, but it is typical that they earn something. And this would be more liquid than some other savings tools, but less liquid than checking accounts. And that's because a lot of times there are restrictions to how many times you can withdraw money out of your savings account in a month or something like that. There may be some fees built in, and therefore it's not as accessible as your checking account. Features of savings account. It is effective for storing emergency funds, money that you want to be able to get access to very easily if there's an emergency. They may require a minimum balance or have a limited number of withdrawals each month, like I just mentioned. And if you're using a credit union, these are called a share account. Money market deposit account is the next one. This is an account that usually has a minimum balance requirement and tiered interest rates. So tiered interest rates are the amount of where the amount of interest earned depends on your account balance. So if you have more money in your account, in your money market account, you will earn a higher interest rate on that money. If you have less money, you will earn a lower interest rate. So it benefits you, obviously, to have more money in there so that you are earning the most interest on your money. This is going to be less liquid than checking and savings accounts because of those minimum balance requirements. It may require that you have $500 or $5,000 to start and open the account in the first place. And then they might require that you, like if you earn more money or you put more money in, they might allow you to withdraw, but you have to leave a certain amount of money in there, say $500 or $1,000. And so that means that you're not able to actually access all of your money really, really easily. Or if you do get it out, there may be some penalty fees involved. Other features of money market account, you do usually have to deposit a minimum amount to open the account, typically $1,000. And it's similar to a savings account, but it earns a higher interest rate and has higher minimum balance and deposit requirements. A certificate of deposit, also commonly known as a CD, is an account that's used for a fixed period of time, and it allows restricted access to the funds. The interest is going to vary. So, for example, you can set up a CD for 1 year, and the opening amount has to be $500. So, and there's all kinds of different ones that you can open, but that's just an example. And so if you put $500 in and you leave it in there for a year, then you're going to get the most benefit out of that CD. However, if you get it out early, there's probably going to be penalty fees. You might not get to keep the interest that you were supposed to earn on that CD. But say you put that same $500 into a 5-year CD, it's going to return a higher interest rate for you. And this is going to be the least liquid savings tool, mostly because there's that time restriction on them. Typical CDs are 1 year, 5 years, 10 years. And so the purpose is you are committing to that time frame. And if you leave the money in there for that time frame, then you are going to earn a much higher interest rate on it than you would if you just had it in a savings account or a money market account. But if you get it out early, then you're kind of breaking the contract and you're not allowing it to grow like it should. And therefore, you're going to probably lose all the interest on it, maybe pay some fees. There may be some restrictions on how much of it you can actually take out. And therefore, it is the least liquid, least accessible savings tool. Other features of CDs. The range is from 7 days to 10 years, how long you leave the money in there. And it can require a deposit of anywhere from $100 to $250,000. There's all kinds of them out there. If you leave the funds in there for the designated time period, there is limited risk and no fees. So you're pretty much guaranteed to earn some interest on that money. No risk in that way, and no fees if you leave it in there in a certain amount of time. Okay, page 3. Now, the circles at the top of this page, there are only 5 of them, but there are however many, 7 on this slide. So you are just going to pick 5 and put them in your circles. So the question is, what are some factors that you want to consider when determining what is the most appropriate savings tool for your financial goal? So you want to think of all of these things. How much money do you have? Amount of funds available. Purpose of the money saved. When is the money needed? Do you need to save it for 3 months? Do you need to save it for 3 years? That's going to depend on, or that's going to be a factor in choosing which savings tool is right for you. The liquidity. Are you going to need to possibly have quick access to this money? Interest. How high of an interest rate are you hoping to get? And the savings tool requirements, such as starting balance, opening balance, or fees or penalties. And fees is the last one. So just a quick example, we've got Avery, and his goal is to create an emergency savings fund. So he is going to choose a savings account because the funds are going to be easily accessible to him, which you would assume he wants in the case of an emergency. Javier's goal is to purchase a new car within the year. So he's going to choose a money market account because he can get higher interest rates. And we know that he's willing to leave that money in there for a longer period of time. Doesn't need it to be quite as liquid. All right, couple different things on this slide. I think that's all of them. So this is going to answer the next 3 big areas, pretty much the rest of the page for you. So the first question says, list the savings tools from most liquid to least liquid. And so we've got most liquid, meaning you can access it the easiest, and that is a checking account, then a savings account, then a money market deposit account, then a certificate of deposit. And certificate of deposit would be the least liquid because you can't necessarily have access to all of your money right away. And then the next blanks, the next little arrows say list the savings tools from highest interest to lowest interest. And you can see that the highest interest starts on this side and moves that way. So it's pretty much the same thing, except now we're doing it backwards. So certificates of deposit are going to offer you the highest interest rate, money market deposit account next highest, savings account next highest, and then checking account very lowest, if at all. The last question says, what does higher interest rates are a trade-off for lower liquidity mean? So we're looking at this example right here, and we can see that if I want something to be really liquid, very, very accessible, I'm going to get no interest or very low interest on that thing. If I want high interest, that's going to be something that I'm going to have to keep in the bank and not get access to that money very easily. So remember that interest is earning money, or is the price that someone pays you for using your money. So when you put your money into a savings account or any of these savings tools, the bank wants to use that money and loan it out to people or things like that. And so obviously you can still access your money whenever you need it, but they're paying you interest for the convenience of being able to just use your money for some other purpose while you're not using it. So the longer you leave it in there, the more interest they are going to pay you. And that is all I have to say.